Good morning, everyone. So today I'm going to solve 5 questions from chapter 3. So these questions are the total overview of this chapter actually. So this is the first question. You can see that calculate the difference between the implied value by the purchase price and the book value and calculate the difference. So exercise 1 will help you to calculate the book value, to calculate the implied value, and to find out whether there is any difference or not. So to find out the difference is important for another part of the questions, and to calculate the implied value and book value also important. So this is the introduction question from this chapter. So you are given different cases. Based on the different cases, here we have 4 cases, and we have to calculate the implied value, we have to calculate the book value, and we have to calculate whether we have any difference or not. So how to calculate the implied value if we think case 1? So these 2 information will help you to calculate the implied value, because investment cost divided by the percentage will help you to find the implied value. So implied value equal this amount. So you can do with me. So this is your investment, and divided by the percentage is 100%. So this is $1.2 million. So this is, as it is 100%, so this is our implied value. So we calculate our implied value. We calculate our implied value. Then we have to calculate the book value. The book value will come from these 3 columns: common stock, then additional paid-in capital or other contributed capital, and if we have retained earnings. Okay, common stock, retained earnings, these 2 are the book value, but in this question we also have some additional paid-in capital. So if we add these 3, then it will give us the book value. So we add these 3, and the book value is 1.150,000. So we calculate implied value and we calculate the book value. Now we can see that implied value is higher and the book value is lower. So we have a difference. So the difference here is $50,000. It is the difference. So we are going to do the same for every cases. Like here, this is the investment cost. Divided by, we have 85% investment. Now we can get the 100%. So 100% here is $1 million. So if 80% investment is $850,000, so implied value means 100% market price is $1 million. So this give you the implied value. Now we are going to add this 3 for the book value. So here if we add this 3, then the book value is $800,000. So the difference here is $200,000. So calculate implied value, book value, and the difference. So we can go through this way, very easy. So this is this number. Then retained earnings, this is the negative, right? Why this is the negative? Maybe company declared dividend, okay? Declared dividend and paid dividend from the retained earnings, so minus items, or some other reason that company distribute the capital. So dividend is retained earnings is the minus sign here, right? So this 750,000 plus 300,000 minus 250,000. So here retained earnings minus means company maybe distributed dividend, we don't know, from retained earnings, or company distributes some capital. Anyway, so this is the minus item. So if we add plus and minus, the amount is $800,000. And the difference is a difference. Then the last question we don't have other contributed capital. We have common stock and retained earnings only. And this is our investment, 60%. Then the book value is $650,000. And the difference is 350. So I told you that why this question 1 is important, because if you don't know how to calculate implied value, how to calculate the book value, and if you don't know how to calculate the difference, then you cannot solve the rest part of the questions. And also you have to remember that whenever we have less than 100%, whenever we have less than 100%, we have to establish our non-controlling interest. Although this question do not ask you to calculate the non-controlling interest, but it is your information that if it is less than 100%, okay, then we have to establish non-controlling interest. So we'll see why this question 1 will help us for question 2 and another question. Let's see now question 2. So on January 1st, 2023, hardware company purchased 100%. That means we don't have any non-controlling interest of Shovel company for $150,000. So up to here, you have to immediately calculate the implied value. And I already told you how to do that, right? It is your investment. It is your investment divided by, as it is 100%, so the same amount. So we calculate the implied value. We calculate the implied value. So at that time, Shovel company's common stock is given $100,000, and retained earnings also given $50,000. So common stock and retained earnings both given, right? We don't have additional paid in capital. So from here, you have to calculate the book value that we already learned from exercise 1. Book value equal also $150,000. So this question do not have any difference. Why we don't have any difference? Because book value is $150,000 and implied value also $150,000. So therefore we do not have any difference, right? We do not have any difference. Then prepare the journal entries for the parent company to record the investment. This is your first requirement. So you invest $150,000. Okay, you invest $150,000. What is the journal entries? This is the first course requirement. Second requirement, what is the elimination entry? We know that when we prepare the worksheet, we have to eliminate some transactions that already happened, right? So what is the elimination journal entry? This is for requirement B, and requirement C says that if Sober's common stock at acquisition was the same, but the retained earnings is the different. So previously, common stock $100,000, retained earnings $50,000. So book value is 150. Now third question said that requirement C said that common stock same amount, but retained earnings is only $30,000. What would be the elimination entry? Okay, because according to requirement 1 and requirement B, we don't have any difference, right? But when we go to requirement C, we will find that we have a difference. So if we have a difference, where should we put? Should we put in the debit side or credit side? Okay, so let's see. Requirement 1 is very easy. Your investment is debit. So if you are the parent company, investment in subsidiary company, investment in subsidiary company debit, $150,000 is the investment. Then according to this question, we invest our cash. We don't have any information about whether we invest our common stock or not. So if you invest common stock, you have to credit common stock. That we learned our previous lessons. So here we don't have any common stock, so we give them cash. So investment in subsidiary company debit and cash or common stock credit. So this is our requirement A journal, requirement A. But we have another important point here. You can see that Power, that means parents company, incurred $5,000 indirect expense related to the acquisition. So we also learned from this chapter that if we have any direct or indirect expense related with acquisition stock, we have to record separately, right? Before we record 150 plus this 5,000, right? Before previous method, if you remember. But according to the new rules, we cannot include this $5,000 as a capital investment here. We cannot capitalize them. So this cannot be new rule. We can't capitalize. We cannot capitalize this $5,000. So what we have to do? Then record separately. So we can't capitalize this acquisition cost. We have to record it separately. So you can write here combination cost debit. This is the business combination expense. You can write here business combination also, no problem. This is the business combination expense debit $5,000. And we pay cash credit $5,000. So this is the requirement for A. A said that record journal entries on the parent's company for this investment in subsidiary company. So we have two components here. We invest our cash to acquire 100% of subsidiary company. And in order to acquire other company, we have some additional expense, right? This additional expense we record now separately. This is requirement 1. Go to requirement B. prepare the elimination entry that would be required on the works paper. Yes, so we have to eliminate some accounts. So as we don't have up to here, we don't have any differences. We no need to calculate any differences. So this account should be eliminated first. Investment is going to decrease now. So this is credit. This one is closed. We are going to eliminate our investment first. So investment close. So $150,000 before we record debit. Now we record credit. So investment account close, you can see here. Before we record debit, now we record credit, it is closed. And we have to close the book value, right? We have to close the book value. We have to close the common stock. Common stock of subsidiary is $100,000. We have to close common stock. And this question do not have any additional paid in capital. This question do not have any additional paid in capital, so we cannot record them. We have retained earnings, so we have to close them. So we close our investment and we close the equity account of subsidiary. So first these two account, these two from subsidiary, you know that. We close this account from subsidiary and this account from parents. So these two accounts are closed. We can only record, instead of these two items, we are only going to record parents companies and subsidiaries companies asset and parents companies and subsidiary companies liability, right? So we close them and we will keep them only asset and liability. So this is the things we are going to keep. P plus S. And for the liability, also P plus S. So these accounts we are going to keep. We are going to keep these accounts and we close subsidiaries companies equity and we close parents companies investment. Anyway, the question said that, requirement C said that if retained earnings is not $50,000, if it is $30,000, so we close these two first. Question said that these two amounts are not similar now. They said that before we had retained earnings $30,000, $50,000, not requirement C said that not 50, it is 30,000. Do you understand? We close common stock $100,000 and we close retained earnings $30,000. Before it was 50, now instead of 50 it is 30. And we have to close this account. Investment in subsidiary. So these are the closed actually. And our investment is $150,000. Now we close our investment in subsidiary. We close subsidiaries common stock. We close subsidiaries retained earnings. Now debit and credit is not equal. Why debit and credit is not equal? Because you can see that because we have past exercise, implied value and the book value is not similar, right? So there is a difference. Do you understand? There is a difference. So implied value and book value, there is a difference. Same here. Same here, you can see that This is the book value, right? And this is the investment. And they are not similar. As they are not similar, so there is a difference, right? Now, where should we put difference? Difference, sometimes, last class I told you that we should record difference, sometimes debit, difference, sometimes credit. So in this situation, where should we put the difference? It is debit side or credit side? Debit side, right? Debit side is lower. So very careful. So difference, sometimes debit, difference, sometimes credit. This example said that difference goes to the debit side. Why? Because debit side is lower. So difference should put in the debit side, difference. So the difference between implied value and book value is $20,000. So this question said that we have to calculate the difference and put in the debit side. Now maybe next question will tell you how to handle this kind of difference. If we have any difference, how to handle this issue. So see exercise 3. So parent company purchased 100% of the stock. Again, 100%, we don't have any non-controlling interest. On January 2nd, 2023 for $450,000. Okay, so we have to calculate implied value. We have to calculate implied value. So implied value here also 450 because we acquire 100%, right? Now at the time, the stock company's capital, common stock $300,000. This is the common stock of subsidiaries $300,000, and the retained earnings $150,000. So also look at here, 450, right? So book value and implied value similar. Book value and implied value similar. So easy question, maybe this one. And at the time, the parents companies and a stock company, the stock is the subsidiary company, had no intercompany transactions. So this chapter we don't have any intercompany transactions. So chapter 4 we will learn. The next chapter we will learn whether they have any intercompany transactions or not. So sometimes intercompany means I acquired 100% or 80% of your asset stock, right? You have to give me dividend, right? That means subsidiary company should give some dividend to the parent company because they acquired their stock. So this kind of intercompany transaction we will learn in chapter 4, not here. Anyway, there is no intercompany transaction, so you no need to worry about this issue. And any excess of the value implied by the purchase price over the book value is attributed to the land. So if we have any difference, the difference is going to allocate to the land account. So unfortunately, this question we don't have any difference. Do you have any difference? Look at here. Our implied value $140,000. Sorry, $450,000. And if we add the book value also 450, right? So don't have any difference. So this is not important question, important part, but make you confused. Okay, question said that any difference should allocate under land account. Actually, we don't have any difference, right? We don't have any difference. So this is a confusing sentence in this exercise 3. Now prepare journal entry to record parent company's investment in account. Okay. Prepare journal entry to record investment in stock company. Prepare journal entry to eliminate and complete the worksheet. So this is, we already learned how to record investment in subsidiary account. We already learned how to close or eliminate investment account and book value. And this question is going to add another part, complete the work paper. Complete the work paper. So in your exam question, you may have work paper. Now we can do some quick journal that we already know. So here investment in subsidiary debit. Investment in S company debit. So we invest $450,000. And the question said that we paid cash. So nothing new. And in this question, we don't have any combination, business combination cost. So we have to eliminate them. We have to eliminate our investment credit. $450,000. And we have to close common stock. We have to close retained earnings. We don't have additional paid-in capital. Close the retained earnings. And how much? It is 300 and 150. So here we don't have any difference. As we don't have any difference, these sentences are meaningless. Any difference are going to allocate to the land. So this is nothing important for this question. So we do this. Now we are going to prepare the work paper. We are going to prepare the work paper. So this is given in the question, right? This is from question. Question already give you this information. Question already give you this information that we have patents companies. This is patents companies, parent companies, assets and liabilities and equity. And this is subsidiary companies, assets, liabilities and equity. We are going to eliminate something. Then we prepare a consolidated balance sheet. Now we have to do some elimination first. So this is the closing entries. This is the closing entries. So before, look at here, investment in subsidiary companies to close, make it credit. This came from the journal. Look at here, in the journal, this is the elimination. This is the elimination part here. So we find that 2 accounts debit, 1 accounts credit, right? So we just put this information. So $140,000, it is credit. So we put here credit. Then common stock debit, retained earnings debit. We put these 2 items here. These 2 debit. So we done the closing. So this is the elimination column. We close these 2 accounts. Now remaining, we should have asset, liability, and parents company's equity. Okay, so here, last class, if you remember the formula, okay, we are going to apply this formula. Debit. If you have all debit, then you have to do plus. If you have all credit, we should plus it. And if we have any debit and credit, if it is the mixing or combination, then we should do the minus. Now we should know what are the accounts. Up to here, all are the debit, right? All asset debit, liability credit, and common stock retained earnings credit. So we know debit and credit from here. And we know we have another debit and credit. Then we have to plus and minus we write here. Anyway, so you know this. So now here it is $250,000. And don't forget that this column is P plus S asset, P plus S liability. Then we have $100,000. Then we have $130,000. This account is closed. Nothing is remaining here. Then we have $850,000. 150,000. And if we add all assets together, parents and subsidiary, it is 148. So this is the all total assets for parents and subsidiary. So in the exam, you no need to write P plus S. You no need to write this P plus S, okay? Just this is when you will revise your lecture, you can remember that they are the parent and subsidiaries asset and assets, right? So as we already record asset, look, we no need to record. This is also our asset, right? This is the parent's company's asset. So we already record all the parent's company's asset and subsidiary company's asset. So we no need to record the investment in subsidiary. We close this. Now liability, what is the amount of liability? It is $2,000 to $5,000. Then subsidiaries companies book value is going to decrease. Book value means equity, right? You record subsidiaries companies asset, you record subsidiaries companies liability, and asset minus liability means equity, right? So asset minus liability means equity. So we no need to keep this their equity again. Then it will be double recording. So it is closed. We are only going to keep parents companies common stock. We are only going to keep parents companies common stock and retained earnings. So this is only for P. Now if we add the total column, here it is 450. This is 450. So debit 450, you can see that debit 450 and credit 450. This is elimination, right? Close. Do you understand? Then we have remaining this amount. So this is about question 3. This is about question 3. Now let's see question 4. So question 4 also very easy. So use the information in exercise 3. So we are going to use all the information from exercise 3 and assume that parents companies paid 360,000 before they paid 450, right? Before they paid 450, now they paid 360. Before they acquired 100%, now they acquired 80%. So as it is 80%, you have to think about your NCI, non-controlling interest. So you have to establish our non-controlling interest. It is less than 100%. Any difference and common stock, you know that common stock was how much common stock? $300,000, retained earnings $150,000. So we are going to use all of their other parts. So their common stock 300, retained earnings 150. These are similar, no problem. Again, any difference between implied value and the book value, we are going to allocate under goodwill. Under goodwill. So if there is any difference, but at this moment still we don't know there is any difference or not, right? At this moment, we still don't know whether we have any difference or not. If we have difference, we will put it, we are going to allocate this goodwill. And again, difference may be debit, difference may be credit. So let's see the question first. Elimination journal. Prepare the elimination journal. Elimination journal. Now we know that investment in subsidiary companies credit before we record investment debit, investment in subsidiary company credit. And according to this question, what is your investment? You invest $360,000. This is your investment, and it is credit. So as we are talking about elimination, it is close. We closed our investment in subsidiary because we should record it debit. Now we have to close common stock of subsidiary. It was $300,000. So in the exam question, in the exam time, you also no need to record this closed, just for your reference. Retained earnings. So we are also going to close retained earnings. Yes. So these two closed. It is how much? According to this question, $150,000. So this is closed common stock, closed retained earnings, closed investment. Then we have to record non-controlling interest, right? Non-controlling interest, we have to record it because we acquired less than 100%. So non-controlling interest, you know that it is credit. NCI, non-controlling interest is credit. Why it is credit? Because it should go to the credit side. It should go to the equity side of the balance sheet. Can you remember? Non-controlling interest should go under the equity account of parents company. So equity account means it should be credit. So how to calculate this? Again, we should go back to our first question. Anyway, we have to calculate the implied value first. So our investment is $360,000. We acquire 80%. We acquire 80%, right? And times 20% is the subsidy non-controlling interest. So we have to calculate the implied value first. We have to calculate the implied value first. This is the implied value. And 20% of the implied value goes to the non-controlling interest, 80% goes to ours. So here, non-controlling interest is $90,000. Now tell me, do we have any difference or not? If we have any difference, we have to write difference here. This is the column for difference. This is the column for difference. So according to this question, question said that if you have any difference, okay, question said that if you have any difference, allocate this difference to the goodwill. Now, this is the journal we made. We close our investment account, okay. We close our investment account, we close subsidiary companies equity, and we established. So NCI is established. NCI established. We established NCI. And how to calculate NCI? You have to calculate the market value, means implied value. After calculating implied value, 80% goes to parents company, 20% goes to non-controlling interest, right? So 20% goes to non-controlling interest. So this is $90,000. Now, do we have any difference between debit and credit? According to this question, do we have any difference? No. So as we don't have any difference, don't write difference. Although the question give you some confusion. If you go to the CP exam, they will give you these confusing sentences. Okay, they said that difference should be allocated under goodwill, but when you solve, you find there is no difference. Maybe you will do mistake and try to write a difference here. Actually, there is no difference. Okay, there is no difference. So if there is no difference, be careful during the exam time. If we don't have any difference, we no need to write difference. So we close them first. We close them, we established NCI. Now you will see any difference or not. Okay, there is no difference. So this is about exercise 4. So what is the summary of exercise 4? If we buy less than 100%, then we have to establish. You have to establish non-controlling interest. And how to calculate the non-controlling interest? First, you have to calculate the implied value. Okay, we have to calculate the implied value. After calculating implied value, 80% goes to parents company, 20% is the non-NCI, non-controlling interest. Now let's see the last exercise for this chapter. So again, use the information from exercise 3. We are going to use information from exercise 3 and assume that patents companies paid $400,000. So exercise 4 said that we paid 360, right? Now not 360, we paid $400,000. And as we paid $400,000 for how many percentage? 80%. 80%, so we should have non-controlling interest. So we have to establish. So we have to establish NCI. And you should know how to establish NCI. You should calculate the implied value times 20% is the NCI. That we already learned from our exercise 4, how to calculate NCI. Anyway, any difference between the value implied and the book value, we are going to attribute or we are going to allocate to the land. Now I told you the difference sometimes, if we have any difference, right? If we have any difference sometimes debit, difference sometimes credit. And where should we put this difference? In the land. Now if we go to, if we write difference in the debit side, it means that land value will increase. If we write difference in the credit side, it means that land value will decrease. Do you understand? The very, very important point. I don't know, I forget we have any land difference here or not. But if we have any difference, right? First, you will calculate difference. After calculating difference, you have to find out where should you write it, debit side or credit side. Debit side means land value will increase and credit side means land value will decrease. Now let's see by reading the question. Prepare elimination entry. We should eliminate common stock, retained earnings of subsidiary company. We should eliminate investment in subsidiary company. Then number B said that allocate the difference between implied value and book value. So we are going to allocate the difference if we have. Complete the worksheet and prepare a consolidated balance sheet separately. And you are given this information. These are the parents companies, asset, liability, and equity. These are subsidiaries companies, asset, liability, and equity. These are the elimination entries. After eliminating, we are going to keep parents companies and parents plus subsidiaries asset and liability, and parents companies equity. And if we have any non-controlling interest, yes, we have non-controlling interest that goes to. We have non-controlling interest that goes under the equity section. So this is the question. Now let's solve the question. First, we should do this one. Eliminate some transactions. Then we have to find out whether we have any difference or not. Now I can show you again to make it easy, or we have to credit investment in subsidiary company. So this is closed. So all accounts are not going to be closed. So investment close. How was our investment? According to this question, investment is $400,000. You can read the question. Question said that now assume that our investment is $400,000. Okay. We close our investment credit. Then we have to close the common stock of subsidiary. What was the common stock of subsidiary? If you remember, it is $300,000. So common stock closed. Common stock closed. Then we have to close this question have the retained earnings. So this question has the retained earnings. We are going to close it. What was the retained earnings? According to this question, $150,000. So this is given in the question. We close common stock and retained earnings. We closed investment. Then we have to establish NCI. Can you remember? We have to establish NCI. And NCI is credit. Why credit? Because it goes to the equity section. Now first you have to calculate the implied value. Can you remember how to calculate the implied value? So you can do it. So here it is something like $100,000. And if you don't know that, you can go here. You can go here. So here our investment is how much? $400,000. This is the investment, right? 80%. If you divide by 80%, become 100% times 20% NCI. It is $100,000. Okay. Now we have to see whether we have any difference or not. If we have any difference, where should we put this difference? Debit or credit? Now, do we have any difference here? Of course, we have a difference, right? Debit is 450 and credit is $500,000, right? So now difference should go which part? Debit side, right? Yes. So debit side means the value of land will increase, because question said that if there is any difference, we are going to allocate the difference to the land account. So here we find the difference should go to the debit side. So if you study my previous lessons, I already show you several differences. Differences sometimes debit, differences sometimes credit, and how to handle them. So if you want to learn more, you have to go back to my previous lesson. So here we find a difference. So difference between implied value and book value. And we find that the difference is the debit. Now, where should we put difference according to this question? Difference should go to the debits, to the land, right? To the land. That means this account is going to close. We close the difference and we transfer it to the land account. So before we record, look at here, before we record, this is debit. Now we are going to record it credit. We are going to record it credit. So if you record it credit, what is the meaning? Meaning is we close the difference. We close the difference. Why we close the difference? Because the question said that don't keep the difference. If you have any difference, allocate it to the land account. Okay, allocate it to the land account. So you close it. And as difference is the debit, right? It means that land value increase. So if land increase, it is debit. Land debit, $50,000. Do you understand? We close subsidiary company's book value. We close parents company's investment. We established NCI. After that, after doing these steps, then you have to looking for whether you have any difference or not. Don't look at difference from the very beginning. You have to close common stock, retained earnings, additional paid-in capital. You have to close investment in subsidiary company. You have to establish non-controlling interest. After that, okay. So difference is the last step. Difference is the last step. Then we have to close the difference. So if here difference is in the credit side, for example, look at here. Difference is credit. For example, difference is credit. Okay. If difference is credit, how to handle the journal? Now to close, difference should be debit, right? To close, difference should be debit and land should be credit. That means land value decrease. Okay. So this is, we already learned from our previous lesson. Now, based on, you can see that based on this debit, we have how many debit we have? 1, 2, 3, 4. We have four debit and we have 3 credit here, right? Now, these items we are going to put under this debit and credit column. We have this work paper, right? We have this work paper, we have debit side, we have credit side. So this column, you should have these 4 items. You should have these 4 items, and in the credit side, you should have these 3 items, and you have to look at the specific accounts. Like here, investment in subsidiary. Investment in subsidiary is credit side. This is credit. What is the investment in subsidiary? This is investment in subsidiary. We put in the credit side, right? We find that common stock debit. We copy common stock here. Where is common stock of? This is common stock of subsidiary. Then retained earnings debit. Copy it. Retained earnings debit. Retained earnings debit. Then we have difference debit. Look at here. We write difference debit. What is the difference? This is the difference. Difference we write debit. We write debit. Then we have land debit. Look at here. We have land debit. We copy this 57. What is the land? This is the land. Land debit, right? Land debit. Then we have difference. Again, look at here. Before we record difference debit, now we record difference credit. We record difference credit. So what is the difference? This is the difference. Before we record debit, now we record again credit. Now difference becomes 0, right? Look. Difference becomes 0, right? And this difference, where we transfer? We transfer to the land. Transfer to the land. Now we put debit items in the debit side. Maybe we have another. So we have 1, 2, 3 credit. 1, 2, where is another one? For non-controlling interest, yes, we have non-controlling interest $100,000. So this is non-controlling interest. You can see that this is non-controlling interest column. We put in the credit side. So after, if maybe in the exam question, I do not ask you to record this journal entry. Maybe, I don't know. So even though I did not ask you to do this kind of journal entry, I suggest you can do it by yourself. If you can 100% successfully do these journal entries, then you can 100% answer the work paper. Do you understand? So if you have any mistake in the elimination entries, then you are going to do mistake also here. So you should learn very well how to close subsidiaries company's book value, how to close investment in parent company, then how to establish NCI, and where should we put difference, debit or credit. And after putting debit and credit properly, then we are going to allocate this difference to land or goodwill, something like this. So after that, after that, we are going to follow this again. This formula. So this formula will help you to solve this question. Anyway, so this is something like $250,000. 100,000. 130. So investment close, difference close, right? These two account close. Then we have plant and equipment. Plant and equipment 850. Now look at your land. This is the land account, right? So we know that land normal balance is debit. We know this. Land normal balance is debit. So this is parents company's land. This is subsidiaries company's land, right? So this two is going to add. And this is also debit. So these three accounts, all three are debit, right? All three are debit. So debit means plus. And it is $200,000. Then what is the total asset now? Total asset for parents and subsidiary, it is this is the total asset of parents and subsidiaries. Then liability, we have parents and subsidiary liability, it is $175,000. Then parents company's common stock, we keep parents company's common stock, right? We keep parents company's common stock and we close subsidiaries company's common stock. We keep parents company's retained earnings $2,000 to $5,000, and we close here subsidiary company's common stock retained earnings. Then we established our non-controlling interest is to go under equity side, put under equity side. Now debit and credit should be equal because it is the elimination part. Look at how we eliminate all these accounts. We eliminate all these accounts. And it is 550. So these two accounts should be similar. Because elimination means debit and credit should be equal. Look, these two accounts equal. These two accounts equal. Right? After eliminating, we establish our NCI. This is the parents companies. Okay, this is NCI. I can write shortly here now. This is NCI. This should be only parents companies retained earnings. This is only parents companies common stock. And this liability is P plus S. So chapter 3 very easy, but chapter 4 is difficult. So if you don't have very good understanding from chapter 3, chapter 4 is difficult for you. So in the chapter 4, you also learn work paper, but look at it, this work paper, what is the date of this work paper? What is the date of this work paper? This is the acquisition date. Acquisition date work paper. And chapter 4, we are going to learn after the acquisition, maybe 1 year later, when two companies have some intercompany transactions, how to handle this kind of things. So this work paper is about the date of acquisition. And this column we are going to copy and prepare balance sheet separately. We're going to prepare balance sheet separately. And you know that this is the balance sheet format, right? This is the balance sheet format. We have asset column, we have liability column, we have equity, column, something like this. So this asset again, as it is consolidated, it is both parents and subsidiary, right? So these assets are P plus S. Parents and subsidiaries companies asset. And if we go here, we have cash, accounts receivable, inventory, then plant and equipment and land, right? Plant and equipment and land. So these are the closed. Yeah, so from this asset, we close investment in subsidiary, we close the difference. Then we have only cash, accounts receivable, inventory, plant and equipment, land, and total asset. You can see here. You have cash, accounts receivable, inventory, plant and equipment, land. Clear? Then this liability also P plus S. We have only one liabilities. Then we close this account. We close subsidiary companies equity. We close subsidiary companies. We close subsidiary companies retained earnings. So what should we have? We should have parents companies common stock and parents companies retained earnings. You can see we have parents companies common stock and parents companies retained earnings, right? We have this, and we establish non-controlling interest. And several times I told you that non-controlling interest should go under the equity section of parents company. So this is only for P. This is only for P, and established NCI. So these items goes under parents company's equity. So parents company's equity plus we establish our NCI. So this is the NCI. So this is the work paper format, right? Because in the work paper we close, after closing everything, we prepare our balance sheet separately. Balance sheet separately. So this is all about your chapter 3. This is all about your chapter 3. So next class we'll start chapter 4, and it is quite difficult. Do you have any question?